And we're back. Did you know that being short Chinese tech is one of the most crowded trades right now? Seems like shorting Alibaba and Tencent was for a while an easy way to make money, but not in the last 2 weeks. Seems like you, my good friends on YouTube, and myself, who are long Chinese internet, have the upper hand here. So I heard that some people who are watching my research videos are taking action on my insights and making money from my analysis. And if you've made money listening to me, I celebrate with you. But just as a reminder, please remember that my channel is for research and educational purposes. But that said, I do hope you make lots of money. Anyway, with that disclaimer out of the way, I'm glad you're back here with me today. We've got a lot to talk about. In today's video, I want to introduce to you my thought process, the way I think behind who I believe will be the winners and losers of the changing regulation landscape in China going forward, later this year, early next, forward-looking. I also want to share with you what institutional investors are doing with their positioning so that you can be a little bit more tactical with your approach. And knowing what are crowded trades will help you sidestep those big risks. And I want to share with you how I'm thinking about this market. So if you're a returning subscriber, buckle up and let's dive deep again into my thought process on a new emerging thematic trade that's happening behind the scenes and how to play it. And if you're a new subscriber, welcome, my name is Larry. Join me on this adventure, and if you like the critical thinking presented here, then definitely subscribe so that I can see you in my comment section below if you want to share your opinions with others. And if you're long China, you better hit that like button because more people will see my videos, and that could bring the market higher and send the bears scrambling. Okay, let's get started. So as you know from earlier this year, what have been some secular themes so far in 2021. I just want to quickly review them because it gives us context onto how institutional investors are positioned. So far this year, the FANG companies plus Microsoft continue to hit new highs. Crypto has gone through its second gold rush, boom bust, and current semi-recovery. And the regulation of Chinese internet tech firms have brought on a very large short trade on this sector. A lot of money has left China, which is one of the reasons I think that these funds have been parked in US equities or even crypto. And now though, where I think the tides are changing is that Blackrock is now the first foreign asset manager to become a mutual fund in China. And I think this is a big news because it's an early signal that cooperation between the US and China might start to somewhat recover down the line. Now, an emerging secular theme that I believe will start forming its own narrative soon, later this year, is what I'm going to call the China regulation trade. I believe that anyone who can navigate the China regulation trade could find additional alpha to add onto their portfolios. So China's regulation on the Chinese internet sector has brought incredible attention onto the most well-known names in Chinese tech like Alibaba, Tencent, Meituan, JD, and Pinduoduo. The ongoing regulation on these companies have attracted short sellers who are trying to exploit the fear in the market. Now, it's estimated that there is nearly $10 billion of short interest alone in Alibaba out of the total $38 billion of short interest on the overall Chinese tech sector. Now, on the long side, based on the data that I have, I can comfortably say that most US investors who buy Chinese ADR shares most likely own the more well-known Chinese companies such as Alibaba or Tencent. And this whole year, unfortunately, the market has been transferring wealth from the long holders over to the short sellers. Now, here's what we know. We know that China is playing catch up with its regulation, and it's been fast and furious, upending the after-school tutoring industry and also flushing out foreign capital from a lot of its companies. Now, this has created a mania in terms of media outlets saying that China is no longer investable. In addition, it's turned sentiment very negative towards China and caused institutional investors to have cold feet about their Chinese exposure in their portfolios. But now let's take a step back and think about what China is doing and why I believe that this past month in August might be the beginning of the end of an easy short China trade. As I recently touched on in a chat with Alibaba Bull and YouTuber Tai Chi Kang, China's decision to tighten its regulatory framework across various industries is designed to make it more innovative and advance the progress towards becoming a more fair society. And once these regulations are in place, the country will have a much more stable infrastructure that is more difficult to manipulate. A more stable infrastructure from which these companies can operate will allow Wall Street to once again have more confidence in their outlook for earnings growth and sustainability. Now, here's what I want to address is what I want to call the China regulation trade, where I think fund managers are positioned with their capital. And after thinking about investor positioning, I think that there are three subcategories to the China regulation trade, which I'm going to give names to. I'm going to call them buckets A, B, and C. Now, bucket A includes sectors that are clearly benefiting from the current regulatory framework. In fact, there could actually even be some tailwinds. And these sectors in China are semiconductors, smart manufacturing, clean energy, artificial intelligence, cloud, autonomous driving, 5G, and Internet of Things. Now, bucket B, these are the sectors that are going through an adjustment period of adapting with the frameworks. These are the companies that I have covered in great detail in my previous videos here on my channel. These are the Chinese internet stocks, and I'm going to call them bucket B. Bucket C includes the sectors where the business models are most likely going to have friction with common prosperity goals. And these are the sectors such as education, healthcare, and real estate. And this bucket naturally has the most headwinds. Now, as you can probably imagine, institutional investors are now heavily focused on being long bucket A. ETFs that track bucket A include ETFs called the CSI China New Energy ETF, the CSI China Low Carbon ETF. Now, institutional investors are mostly long this bucket because they still want exposure to China's growing market, and these industries, for now, have the most clarity. For the sectors in bucket B, this includes Chinese internet companies with large platforms. And these are the companies that I've covered widely on my channel, such as Alibaba, Tencent, and JD. This bucket, in terms of investor positioning, has been sidelined, and for the aggressive hedge funds, they've been shorted. And for the sectors that are potentially in direct competition with the principles behind common prosperity, these are sectors like housing, healthcare, education, and even transportation. These names include New Oriental, TAL, Beaky Holdings, Alibaba Health Informational Technology, and Ping An Healthcare. This bucket has been heavily avoided, heavily underweight, and to a certain extent, heavily shorted. Now, at this point, institutional investors, and this is an important detail, and their team of analysts have already figured out that China's move to tighten regulations over key strategic sectors will benefit renewable energy and advanced manufacturing. These are also sectors that align with China's long-term objectives. President Xi has a goal to achieve carbon neutrality by 2060 and a peak in carbon emissions by 2030. As a result, investors are more and more positive about the clean energy sector. Now, what I did was I researched the public statements made by various investment managers that I could publicly find so that we could spot some very important patterns in their thought process. Now, here are the public statements that I've found from brand name investment managers. And the reason I want to share with you what they've said publicly is so that we can spot patterns in their thinking. And by doing so, we can understand institutional investor tactical positioning. So, from UBS, Mark Hayfully said that we prefer areas that stand to benefit from the global reopening and are less vulnerable to tighter regulation, including energy and green tech. Now, from JPM Asset Management, Mark Mao, he says that we continue to use fundamental analysis to be very selective on companies that have benefited from the new energy vehicle industry. And from HSBC's head of China Equities Department, Caroline Maurer, she says that we believe the Chinese solar energy sector has great opportunity. We continue to be overweight the IT sector, especially the semiconductors and tech hardware and equipment sector. We also believe that autonomous driving chips will be the next area of market focus after smartphone chips in mainland China. This sector has less regulatory risk. Fidelity's International Asian Equities Director, Victoria Mo, says that we like companies that produce clean energy or provide relevant services in a mid to increase energy supply. And we're also interested in some sectors with high policy certainty and growth visibility, such as sporting goods, new energy vehicles, and high-end manufacturing. We also like the biotech sector, as we think it will enjoy further support for research and development and will have little policy headwind. Now, I want you to digest that for a moment. Do you see the pattern yet? All of these highly respected institutional portfolio managers used key phrases here. They are investing in industries in China where they believe are less vulnerable to tighter regulation or has greater policy certainty. Because they got in earlier this year, these managers most likely rode the clean energy ETFs to stunning gains. Now, here's the very important detail. However, if we think one step further, as if this were a chess game, this would mean that big money is very overweight all these green tech sectors while having a severely below benchmark exposure to Chinese internet stocks and stocks in Chinese education, real estate, or the healthcare sector. These underweighted sectors are also the same sectors that are being heavily shorted. Think about that combination. Sectors that are underweighted are the same sectors that are being heavily shorted. I want you to think about that. And as institutional investors, though, their clients would be outraged if they saw that their funds were exposed to companies that are seeing increased negative attention from the media, such as Alibaba or Tencent. And as a reminder, institutional investors can't do whatever they want. They work for their clients, and they have a responsibility towards their clients to find less volatile investments. The only way to do that in their shoes is to identify sectors and companies that will be relatively less impacted by regulations. So their actions form a consensus trade, and they are playing at the investment spectrum where there is most certainty. But herein lies the problem. Most institutional investors are currently overweight this thematic strategy for bucket A, clean energy, renewable energy. That means for retail investors who are considering this sector, be very careful because it might become the next crowded trade. It's quite difficult to find the exact holdings of these green ETFs in China, but very likely these names have EV-like valuations from the fall of 2020, where they are very, very high, very expensive, and the risk of a re-rating is also likely. To prove my point, retail investors in China today are demanding that their asset managers get exposure to green energy stocks, which has pushed some of these new energy stocks to be 10 times above their book values. And as you might know, being short Chinese tech is now one of the most popular trades in the institutional investor community. That is also the same sector, as I mentioned before, that big institutional investors are incredibly underweight. When we put those facts together, I think that being short Chinese tech will be very difficult for bears to have sustainable gains going forward because long holders have already left a long time ago. What we saw last week related to Tencent's gaming ban, JD and DiDi's union development was a signal to the fund management community that clarity is now emerging. And that caused China's BAT companies Baidu, Alibaba, and Tencent to surge 15-20% in a matter of 2 weeks. Knowing that institutional investors being short Chinese tech was a crowded trade was one of the main reasons I was confident enough to use $100,000 of margin in one of the videos that I posted 2 weeks ago. And by my estimates, their short positions were already up at least 15% in just August alone. And having worked in the industry before, I know that institutional investors typically treat short positions as short-term tactical trades. Any bounce in stocks is likely to quickly reverse sentiment and would prompt them to cover and take profits. Now, just for your reference, being long Bitcoin earlier this year was also a crowded trade. And what happened earlier this year was not friendly for BTC. And BTC continues to be ranked as one of the most crowded trades. Now, I'm not saying that crowded trades can't work, but anytime you see unwinds happening swiftly, it's most likely because it was a crowded trade. So this goes back to what I was saying earlier about the China regulation trade. I believe that institutional interest in green energy will eventually become a very crowded investment because everyone is looking for exposures in stocks in sectors in China where there is regulatory certainty. But here's the catch. It's that if your investment has implied certainty, then the future returns are going to be lower, especially if everyone is already in that trade with you. Now, I continue to believe that investor positioning around Chinese internet and the other more uncertain sectors like education is still very, very light. This means that this rally for Alibaba and Tencent still has legs, but I do admit that the easy money was made in the previous 2 weeks. I'm also more confident that Blackrock was approved by the China Securities Regulatory Commission to be the first Chinese mutual fund run by a foreign firm to start managing money for Chinese investors. This development is incredibly important and is worth following because it comes at a very sensitive time for US-China relations. Yet it highlights the commitment that the US and China are following through on the Phase 1 deal while President Trump was in power. And it means that there is an acknowledgement that the US and China do depend on each other and are willing to work together on strategic issues. I believe that this development is helpful because, at least in my mind, it reduces the probability of ADR delisting risk, because that would contradict China allowing BlackRock to enter their mutual fund industry. So this takes another bear thesis off the table, and it reduces the winning potential of short sellers in Chinese tech at this specific price juncture. But once again, if you don't have the time to do this level of detailed research, then make sure to keep your exposure low until you're confident enough in the situation. My exposure in Chinese tech stocks is very high because I'm a high conviction investor. Now, you can follow me here for further investment research if you don't have the time to do it on your own. And I'm not here to talk about China without actually being very long on Chinese tech. I have a vested interest in seeing you, my friends, succeed here, which is why I'm doing this level of detailed research to inform you of where investor positioning is. Now, in the future, later this year, early next, I'm going to be writing periodic updates to an email list that I'm creating. If you're interested in that, links in my description below. And finally, here's my tactical summary sheet here for you so that you understand here is how I'm thinking about the market from a short, intermediate, and long-term perspective. Until then, I will see you next time.